I just created a new indicator. It's called the bullshit indicator, where we call bullshit on some of the crazy predictions we see from so many of the so-called experts on Wall Street. Now, why am I starting off with this segment? Right at the intro? Because lately, I don't know, might be me. I call the market just like you guys. But I've seen tons of end of the world stories throughout all financial media. It's like they're throwing, and not only am I seeing them on these sites, but a lot of these sites list when you scroll to the bottom, like the top 5 stories, and they're always in the top 5. In fact, I can't remember a day that's gone by, and I mean this. I should say over the past couple of months. It's been over the past like 6, 7 years, but it's really getting crazy right now, where you don't see some crazy outlandish prediction of where the markets are headed. Like one of the headlines is next recession will destroy millennials, or signs that a U.S. debt-fueled economy might actually collapse. Drowning in debt, the road to $30 trillion. How federal debt will soon destroy the U.S. These are real headlines, guys. Our debt to GDP ratio is over 100%. That's the danger zone. I'm not going to break down where these stories are, but they're all from very quality, very popular financial media outlets that we all look at and read. But every single day that goes by, more and more of these are starting to show up on these sites. So what I want to do today is cut through all the BS, because many of these calls are like being part of WWE wrestling. I mean, hey, it's very entertaining. People love it. It's great. I grew up on it as a kid. But watching wrestling is harmless. We all know it's entertainment. So many people enjoy it, and that's cool, giving the people what they want. The people in the financial media making these calls, they're influencing your lives. That's a big difference from just being entertained for a TV show or something like WWE or whatever, or an interesting story. They're influencing your life. How? By making you do the wrong thing with your money over the past 10 years. And think about that. That's money you could have used to put your kids through college, retire early, take your family on a nice vacation, buy a new house, have some extra money to pay your ex-wife after your divorce, whatever. I'm not playing Monday morning quarterback here where, hey, if you invested, you could do it all over. But there was signs out there that showed that the markets were going to go a lot higher that, frankly, the bears don't even care about. Why? Because most of these people have an agenda. They want to sell you something. And the best way to do that is to tap into your emotions, especially your fears. Telling you, hey, you're going to lose everything if you don't do this. And of course, they're going to provide a date, right? Usually within 3 to 6 months. Some of them have a specific date saying the market's going to crash on this date if you don't do this, this, and this. And it's funny that they're selling financial newsletters and they're telling you it's going to crash. I don't know how they're going to help you make money. Whether they can tell you to go into cash, I don't know. But it's just funny when you see it. But they, that specific date. Why? Because it creates urgency. Whoa, I really need to see what this guy's saying. He really thinks next month the market's going to crash that day. Holy cow. But that's the game. For example, if you take Peter Schiff's book from 2011, it's Crash Proof, it was called, How to Profit from the Economic Collapse. And then he published another one in 2012 called The Real Crash, America's Coming Bankruptcy, How to Save Yourself and Your Country. That was 2012, How to Save Yourself and Your Country. 2016, same book, except he updated it. He actually called it The Real Crash, America's Coming Bankruptcy, How to Save Yourself and Your Country, updated. Get the word updated. So he updated that book, right? Called it for the crash. Oh, I won't even say 2010, 2000. Let's start 2012. So what do we have here? Very scary titles. Taps into your emotions. New York Times bestseller. You get scared, you buy his book, and then you're in his ecosystem of email barrages, sales pitch to buy gold, invest in his funds, whatever. I'm highlighting Schiff as an example because Schiff is someone that I think you guys know how I feel. But there's a lot out there. And if you want to put all this into perspective, what's not being told is when you look at 2012, when he made that prediction from 2016, again, that's the time when he revised his America's Coming Bankruptcy book, the S&P 500 went from 1,400 to 2,600. It surged 65% from 2012 to 2016. I'm not picking on him because he's wrong. A lot of us get it wrong from time to time. There's a reason why I'm bringing him up. So in 2016, when he wrote the updated version, the S&P 500 went from 2,600 to where is it, around roughly 3,000 today, give or take, a few points. So again, putting all this in perspective, you have a guy like Schiff has been predicting America's bankruptcy pretty much since 2010. I won't take the generational low, though. I won't go there again, which was really from March 2009, but from 2010. But again, let's just use 2012 as an example. That's when he wrote his first America's Going Bankrupt book. And the S&P 500, again, trading at 1,400. Today, it's close to 3,000. So not only do you miss gains on one of the biggest bull markets of the generation, marks up 135%, the S&P after dividends, which will only cost you 0.04% to own the Vanguard S&P ETF. But more important, Schiff is charging as much as 4.5%, which is the max sales charge he charges for his funds. 4.5%. You know why they're not in America now? 4.5%. That's in the way on the way in. You probably don't know you're going to get charged on the way out. Even if you're losing money, you leave. Bye-bye. You get another fee. Crazy. Insane. When you think about that, 4.5% to put money into his funds, which, by the way, just about every one of his funds, including his gold fund, has underperformed the markets over the past 3 years, 1 year, 6 months, 3 months. You pick the time frame. Most of them since inception. So not only did the people listening to him miss one of the biggest bull markets ever, even if the market crashed 50% from today's levels, the S&P 500 would still be higher because it'd be around 1,500, right? It's 3,000 today, compared to when he made his crash call in 2012. Even if it declines 50%, which is going to say, I told you so, it's still going to be higher than when he made his original predictions. Now, I'm going to say a few things here. And at first, you're going to think I'm crazy. I'm sure most of you disagree. You're going to think I'm on drugs. Hear me out first. Because there's a lot of fears out there, like deficits. And I'm going to let you know a little secret. Deficits don't matter. How crazy is that? You probably should the pot. What are you talking about? Deficits? We're sitting on $22 trillion in debt, which keeps rising. And it looks very, very scary on the surface. Again, it's $22 trillion. It makes for a great story. It's awesome. Did you know people have been warning about our massive deficits since the 1970s? In the 70s and 80s, there's still some analysts out there today that have been doing this that long. And you could take what they're saying today, and if you see them do a conference or a video, you wouldn't even know it, but it's the same exact thing from the 70s and 80s. Country's going to be destroyed. Move your assets out of the U.S. The dollar's going to get destroyed. Riots in the street. Same thing. Let me tell you something. You were alive back then, and I was born in 72. Or should I say maybe old enough to invest in the 70s and didn't take any money out of the market, even the 80s. Congratulations. You're a very, very rich person. Now, when it comes to our debt, believe it or not, there's not one economist on earth that can prove high debt levels alone are bad for an economy. Any economist that tells you different is not a true economist, because debt usually fuels economic growth. Look at people and businesses have more money to spend, and most of this lending, which is done by banks and large financial institutions, it's carefully analyzed. Where banks are not lending $1 billion to a company generating $2 million in sales. No, it doesn't work that way. They're very, very careful when it comes to who they lend money to. Similar to an insurance company who knows every single risk before writing you a policy, which is 100% all the time in their favor. Wow, if I die, I'm going to get $10 million. Believe me, they know you're not going to die. They know. They have algorithms and numbers. Yes, that rare instance when that happens by accident, God forbid, but most of the time they know exactly what they're doing. They know the numbers, they analyze everything. Again, it's in their best interest to know that. Their job is to take money from you and not pay you. That's their job. They're not going to tell you that. They're going to say, hey, you should be safe with your family and this and that. But in reality, there's a reason why the insurance companies are the biggest businesses and most high-margin businesses in the world. There's a reason why hedge funds have created reinsurance companies, which is insurance on insurance companies, so they could take that pool of money, because it's one of the only businesses that you pay money up front for something in the future that probably won't happen. And they take that and they invest it within their fund to generate more returns. And if something happens, they pay out. Big deal. It's the greatest industry in the world, insurance. They know exactly what they're doing. But getting back to debt here, debt fuels an economy. Now, say we have another 2008-like credit crisis, right? Which is going to be really tough to happen since it's not going to be caused by the banks, since they're barely leveraged today due to new regulations, Dodd-Frank, which were put in place during a credit crisis. I know a lot of you might disagree with that, but they were super leveraged. I say this all the time. Subprime did not cause a credit crisis. It was the leveraging of subprime. If nobody leveraged subprime, there would have been a pullback in the housing market. Yeah, a couple firms here and there. It was the leveraging where people have to put up the money. It was leveraged 40, 50 times. Synthetic CDOs. That's what crushed the markets, guys, not subprime. It was the leveraging of subprime. That's what killed it. Banks are barely leveraged today compared to how leveraged they were historically. So let's go back to an example where we have a complete meltdown, another black swan event that crashed the global markets and puts us on the brink of total worldwide collapse. My question to you, what do you think the government's going to do? They bailed out everyone during the credit crisis. You know what? They made an effing fortune. Fannie and Freddie paid over $300 billion in combined dividend payments to the government already. $300 billion. If you want to put that in perspective, the total amount of the bailout was $470 billion. It wasn't the 700, whatever. It was $470 billion when all is said and done. Fannie and Freddie paid over $300 billion in dividends combined to the government already. The banks paid back the $245 billion. Which is $545. Again, the bailout was $470. And not only that, the banks paid that back by 2012. 4 years later. Throw in the bailouts for AIG, GE, the auto companies, everyone else, and the government made an absolute fortune bailing everyone out during the credit crisis. Which you may say, well, okay, that's good because now it put us on much better footing. And, people forget. If that would have happened when our unemployment rate would have been 30, it would have been Great Depression. And we might still be in it today if that would have happened. That's how dangerous that was. They say, yeah, well, they I don't know, some people are against it for it, regardless. What you need to understand is it wasn't a good thing that the government made a fortune bailing everyone out. Because what do you think the government's going to do if the market falls 35% or another black swan event? I remember towards the end of last year, the market corrected by 20%. Again, it was up like 15%, so it wasn't like the market felt. I think it was down like 6% on the year. And what happened? I mean, Trump quickly made sure he started talking to China again. Relationships are not that bad anymore. And the market really surged to the first few months of the year in 2019. And he talked about providing more tax incentives again. I mean, it's like everyone's afraid the market's going to come down. It's crazy. But remember, America has a printing press. We could print money forever. I hate that fact. You should hate it, but I'm not talking about it from a political view. I'm not talking about trying to tap into emotions here. I'm talking about how you make money off of this, which is the only thing you should care about. You can go on social media. You can hold up a sign in front of the White House. Do whatever the hell you want. I don't give a shit. My job is to make you money. And that's what pisses me off about all these bears, because lowering interest rates to near zero, backstopping all the debt, and you're still keeping your bear forecast on there means that you have an agenda. You don't really care about people. But you look at it as America with the printing press. Again, I don't like that fact. I'm not saying like, wow, America's got a printing press. You got nothing to worry about. No. I'm telling you what the government's going to do if this happens again. They're going to bail out everyone because they made a fortune. You're looking at the dollar. The dollar is the world's reserve currency. Everybody wants it. By everyone, I mean every country, because it's safe. Now, this will end badly one day, especially if our debt levels keep going higher and higher and higher. If we don't see economic growth, because economic growth is essential when you have debt on your balance sheet. So I say these deficits don't matter. We're growing the economy. If we continue to grow the economy, until it goes forward, we're going to be fine, especially when interest rates low. So that's one thing you can say, well, debt is terrible if you're not growing, or excess debt, I should say. That's bad. But let me tell you something. If we do see the tides turn when it comes to our debt, and all those fears that you worry about, that people have been telling you at least over the past 10 years that you can remember. That's why I bring everyone on board, because everyone's always talking about the last 10 years. Dollar's going to collapse. The market's going to collapse. Everything's terrible, right? Everything's horrible. Say if they're right. You're going to have plenty of time to see it before it happens. And remember the credit crisis, 2006, 2007. Look at the news flow. You could go into it now and Google it. Hey, mortgage companies started to go bankrupt. Default subprime mortgages started to skyrocket again. 2006, 2007. AIG took insurance from every brokerage firm for all the shit to backstop it. We didn't know behind the scenes, but we saw the writing on the wall of what was happening. So what's going to happen this day? You're going to see defaults rise sharply for businesses. If you're worried about debt and debt becomes a major concern, which is not happening. Foreclosures skyrocket, which is not happening. Interest rates surge, which is not happening. GDP falls sharply, which is not happening. You're going to see it in the bank's balance sheets, which still have to go through extensive stress tests every single year, which, by the way, banks are reporting record earnings, some of the highest credit quality and loan metrics, near record common equity tier 1 capital. Very important measure. You don't have to know it. Don't write it down. It's just basically, it's the funds a bank has on its balance sheet to absorb losses in case of, without ceasing operations. So they have to keep a certain amount basically in reserves. Those are near record highs, which explains what. They had to keep that much money in their balance sheets because we're so scared of another credit crisis. Again, that pendulum swings all the way to one side. That's how it is with regulation. So what are these banks doing? They can't really grow. They can't really take on as much risk. What are they doing? They're raising their dividends like crazy and buying back a shitload of their floats. Citigroup, Wells Fargo. I mean, in the next 2 years, because it's basically a 3-year process, they're going to buy back 20% of their floats. 20%. And these companies are paying what? 2, 3, 4% yields. That's how much money they have. People don't want to talk about this. They don't want to talk. They want to scare the shit out of you. It's like, no, Frank, you have no idea what you're talking about. Whatever. We've been in the market. We've generated a lot of money over that time. You could do whatever. It's your money. It's important. But I just want you to hear the other side. And don't be like a left or right politician where it doesn't matter what you say. It's a religion. I don't care. Listen to what I'm saying. Disagree with it. Do your own homework. See if what I'm saying is real. But you're looking at the banks in very, very more powerful than they've ever been in the history of our nation. Throw in interest rates. Going to remain historical low for a very, very long time. I wouldn't say forever, for a long time, which allowed the government to borrow indefinitely. But for now, please do me a favor. Stop worrying about the debt, the deficits, the $22 trillion that people talk about since 1970. It's going higher and higher and higher. And breaking it down between Obama and Trump and how much money they're adding to it and why they're terrible. Whatever. It's nonsense. It's noise. It's noise. It's being brought out today because we have an election coming up. You're going to see all this crap coming out. Scare the crap out of you. But stop worrying about the debt. Because this risk alone has kept so many of you on the sidelines for 9 years. For 9 years, where the market in almost every asset has significantly increased in value. And even if you didn't get it right in 2009 or 2010 or 2011, by 2012, the writing was on the wall that our government, our Fed, all in doing everything they can to inflate the markets, keep interest rates at zero, which is a recipe for almost every asset to skyrocket in price, which is happening. And it didn't really skyrocket that much. I'll get to that in a minute. That's relative to, earnings and what's going on. If you're looking at super low interest rates, huge deal. We have earnings growth of the past 5 years along with sales growth. Unemployment is basically zero. Consumer spending is still strong. So it's funny how many stories out there right now, or even over the past few years, they're just telling you, hey, the markets are so expensive, so expensive. You know how expensive the markets are? They're so expensive, you won't find one expert anywhere that's telling you the stock market is cheap right now. Nobody would tell you that. The stock market's cheap right now. No. It's like you're not allowed to. It's like if you're in Hollywood, you can't say that you like Trump or you're blacklisted. You're not allowed to say that in financial media. It's crazy. You know what? If you long, that's a great thing because that's a huge contrarian indicator. Nobody believes the stock market's going to surge from here. Nobody. Very few people. I'll tell you something else no one's going to tell you. That our stock market is cheaper today than it was 4 years ago. That's a fact. Look at the numbers. I mean, S&P 500 is trading at 16.6 times earnings right now, forward earnings. The 5-year average is 16.5. We're right on it. If you look at the markets, they're not expensive today and are even trading at a discount to where It was trading in 2011, 2012 based on a PE base, full PE. And you may be thinking, Kersey, you know what? That makes zero sense. I mean, stocks are up huge since then, and you're right. But it's about earnings growth because earnings are also up huge, which is why the P and the S&P 500 is cheaper today than it was 5 years ago, even though the market's higher. But I wouldn't go out there and say, hey, the market's dirt cheap. You got to go in and buy. No. But they're definitely not expensive. You're looking at earnings down slightly year over year, which is to be expected since we had the tax cuts go into effect last year. But for 2020, expect to grow close to 10% again. Throw in super low interest rates. The environment's going to stay here for a long time. A near 2% yield on the S&P 500, which was actually higher than the 30-year Treasury, that yield, a few weeks ago. And stocks are definitely not expensive. Provides a good alternative, especially in the global markets where everything doesn't look all rosy out there. Again, something you won't hear in the media. Why? Because it doesn't sell. Greed, of course, sells, but nobody's predicting the S&P 500 to go to 5,000 anytime soon. You don't see any of those predictions. If you did, then that'll get people interested. Most are predicting a 30% plus crash because that's really interesting to people. They will click on a story like that. They're like, whoa, if that happens, what's going to happen to my 401k? And that's why a guy like Peter Schiff is still quoted everywhere. TV, gets paid to speak at conferences. Huge draw, good for him. Because he gets that despite having a terrible track record and being wrong for 9 straight years. So what kind of person do you want to be? You want to be a follower or a leader? If you want to be a follower, go follow the guys with these crazy predictions. It's fine. I'm not a perma bull or a perma bear. When I see the data telling me that we got to get in the market, I'll be the first to let you know. But it's not saying that right now. So I've been telling you to buy almost every single dip for a while. I got nervous before the tax reforms and said, look, we're getting a little top heavy, but the tax reforms changed the game. Added more earnings growth. Companies are paying less taxes, generating more money. When you're looking at people like that, it's entertaining. People love to read stories, watch videos of crazy market predictions, which essentially means more page views, right? Or more money to the networks. That's their motivation. They need you to click on stories. And today, everything's a 24-hour news cycle, as you know, especially when it's not earnings season. There's nothing to talk about for even 3 hours, 2 hours. Maybe there's one good story in the market. Same with ESPN. I mean, now you have football, which is good, but a couple of weeks ago, before football, is like they're talking about how Jerry Jones pissed off Ezekiel Elliott by saying Ezekiel who? And that offended him. I mean, that's what they're talking about because they have to talk about something even though it's meaningless and it means nothing. It's the same in the markets. There's a lot of noise out there, and you have to be careful. The point of this mini rant, if you want to call it, don't fall for the dollar's going to lose its reserve currency status stories. Don't fall for the market's going to crash by 40% by the end of October, which October is the month where we see the biggest crashes. Or if we have an inverted yield curve every single time it's a recession, we're going to have a recession. When people aren't telling you that the S&P 500 goes up an average of like, I think it was 17, 18, 19% around that level. I had that quote. It was amazing. Great research. Before the actual recession. Nobody tells you that the market surges before you actually have that recession. Think of 2005, 6, 7. Before we had 2008, how much the markets went up. Look at the internet bubble, how much the markets went up before you got a bubble. We're not in a bubble. We're not in a bubble. We're not in a bubble because everybody predicts the market's going to crash. That's how you know we're not in a bubble. How many markets have crashed when everyone's predicting? Let me know. I've been doing this 25 years. Never happens. You had only a few guys predicting that the housing crisis and how that market was going to happen. That's when you see it. Now when everybody's talking about it and being worried about it, everybody's cautious. It's on the table. We all see it. We see the risks. And please, please, please don't fall for the U.S. has too much debt and it's going to go bankrupt story. Which, by the way, if it happens, why would you care about reading what anyone has to say? You should buy a cave and protect yourself, weapons. I mean, if that happens, it's going to be mass chaos. But you should buy my newsletter for $100 because this is going to happen next month. It's great. It's great. It's entertainment. But entertainment's cool. We live for entertainment. We all do. We love it. That's why we have to be on our phones. We have to be doing something. I get it, but this is your money, your generational wealth. That's what these people are fucking with right now. And they don't get that. They don't get how many people are listening. When Schiff goes, he doesn't understand how many people listen to every word he says. And so many people have been out of this market and said, hey, you know what? I'm going to trust you. I'm going to go into your funds. They're underperforming. Well, I'm going to get out of it. Okay, here's a 2% charge you're getting out of it. Really? Yeah. 4.5% fees. 4.5% fees. That's great. Unbelievable. Be smarter than that. Be smarter than these people. Because at the end of the day, it's about making money for you and your family. I've been doing this for over 25 years. I love what I do. And I can tell you, most people don't give a shit about you. They give a shit about making money for themselves. And if you have that mentality, especially when you're seeing these crazy headlines and stories, you're going to think a lot differently going in. And that's what I'm trying to help you with.